If the latest market dip made you pause and think, maybe I should delay my retirement, you're not alone. But here's the real question you should be asking. Is the problem the market or is it the plan? Because the truth is, good retirement plans don't count on everything going right. They're built to handle the potholes, the storms, and the surprises along the way. In this video, I'll show you what a strong, resilient retirement plan actually looks like, the kind that keeps you on track even when markets drop 20%. You'll learn how smart withdrawal strategies, stability buckets, and flexible planning can make all the difference. If you're new to my channel, welcome. I'm Jacqueline Ozdemir, a financial advisor with the Ferguson Financial Planning team of CI Asante Wealth Management. I help people build retirement plans that stay steady even when the markets don't. I'm all about making sure your financial plans are built for real life, the good years, the bad years, and everything in between. And today, I'm going to talk about how to build a retirement plan that can handle market dips without derailing your future. I'll walk you through why good retirement planning assumes things will sometimes go sideways, why running out of money is a bigger risk than a bad year in the markets, and how timing matters when you're drawing income, and ways to create built-in stability so you can actually sleep at night. If you find this video helpful, don't forget to hit like and subscribe so you stay in the loop for future videos. Let's begin with something people often miss. Good retirement plans don't assume that everything goes fine year after year. Instead, they prepare for random twists like major market pullbacks or periods when inflation creeps higher. Think about winter driving. If you live in Canada, you know you can't rely on clear roads all the time. You put on winter tires and toss a shovel in the trunk. Why? Because ice, snow, and slush aren't that unusual. It's the same logic for your retirement. We hope for sunny skies, but a real plan must handle sloppy weather too. Too many folks see a 20% drop in their portfolio and throw their plans in the freezer. They think they need to delay stepping away from work because they're afraid they will run out of money. That's why a stronger approach plans for the dips in advance. It sets aside buffers or other resources so when the market wobbles, you can stay on track. When you accept this from the start, you won't flinch every time the headlines talk about a slump. You'll know your winter tires are already on. And let's be honest, what really keeps us up at night isn't a single bad year in the market, it's the fear of running out of money entirely. That's the big worry. You don't want to turn 75 and discover you're scraping by on credit cards because your savings are gone. This is why smart forecasting matters. Good advisors scribble down numbers to figure out how much you can take out of your accounts year after year. They even check what happens if your returns are less than rosy or inflation is more stubborn than usual. Here's a simple example. Imagine you're entering retirement with $800,000 invested. Forecasts say you might earn 6% a year in the market, while inflation hovers around 2%. So you can withdraw a certain dollar figure, say $43,000 in the first year, and increase it a bit each year to keep up with life's rising costs. That looks fine until in your very first year, the market surprises you with a 20% hit. Now you've got closer to $640,000 in your account instead of $800,000. So you panic. Is your plan ruined? Well, a real plan expects dips to happen at some point. It doesn't count on that 6% every single year like clockwork. Instead, it looks at averages and variability. Some years you might see more than 6%. Some years you see less. If your plan is designed for the ups and downs, you won't lie awake worrying that one rough patch means lights out. That's the difference between a plan built for reality and a plan that only works in fair weather. Now, let's dig deeper into something more technical but very real. Sequence of returns risk. That phrase sounds fancy, but it's actually simple. Imagine two retirees both set to rely on their portfolio for income over the next 30 years. For both, let's say the market will drop by 20% at some point. The question is, does it matter if that drop comes early versus later on? The answer is yes. If the market tanks in your first year or year two of retirement, you're forced to sell off some holdings to pay your bills at a time when your portfolio is smaller. That can lock in losses prematurely. The retiree who faces the big dip down the road, maybe year 10, will have had a decade of growth to pad their investments. So they have a better chance to weather the storm. There are ways around this though. For instance, you might plan to scale back withdrawals when the market is hitting you with a left hook. Or you could keep some safe money in another bucket so you don't have to tap your battered stock positions. That's the key though, building flexibility. So if you retire in a tough moment, you're not doomed on day one. Instead, you'll have a plan in place so a rocky start doesn't throw the entire journey off course. One of the smartest ways to soften those market drops, especially in the early stages, is to hold a chunk of your money in something that doesn't bounce like a pogo stick. That could be short-term bonds, GICs, or even just plain old cash for a little while. The idea is that if your stocks are down, you can avoid selling them at depressed prices. You tap into the stable stuff instead, giving your stocks time to recover before you touch them. How big is that stable bucket? Well, that depends on your comfort zone. Some people say, I'll hold 1 or 2 years worth of retirement withdrawals in something safe. Others might hold more, though that could mean less long-term growth. And so there's no one-size-fits-all answer. Instead, you pick a number that lets you sleep at night without feeling like your future potential is shot. Picture you're in a canoe on a slightly choppy lake. If you have a life jacket, you'll worry less about tipping over. Having stable money in your plan is like that jacket. It doesn't give you huge returns, but it keeps you afloat when the waves get rough. Then, when the weather calms down, your growth assets, like equities, have time to bounce back on their own. No frantic selling, no frantic regrets. That's how a stable bucket can preserve your plan. Another strategy that couples nicely with a stable bucket is flexible withdrawals. Many people assume you pick a number like that $43,000 I mentioned earlier, and that's your annual paycheck from your portfolio, no matter what, for life. But life isn't always that rigid, and sometimes you should adjust based on what's happening in the world. If we're in a roaring bull market and your investments are up, you could take a bit more than usual. Maybe treat yourself to that cottage upgrade. On the flip side, if markets are staggering, say they plunge 15%, maybe you dial back your withdrawal for a year or two. You could dip into savings or cut down on a few discretionary costs. Ultimately, that small shift prevents you from ripping out money at the worst time. And this isn't just about math, it's about peace of mind. Many retirees like knowing they can tighten or loosen up as needed without gutting their retirement forever. And sure, scaling back for a bit might not be your favorite thing, but it's often better than delaying retirement for years or sticking to a rigid plan that ignores reality. The goal is to keep your money alive and kicking for decades, so a little flexibility goes a long way. Let's wrap up with the tension we often feel. You want enough growth to beat inflation and last for 25 or 30 years, but you also want to avoid losing sleep when the market throws a curveball. If you want big gains, you might keep a heavy tilt towards stocks, that's your growth engine. But if you panic every time you see red on your screen, that plan could really backfire. You might yank your money out and miss the rebound. On the other hand, going full-blown conservative could mean your money won't keep pace with rising costs over time. Sticking it all in GICs or short-term bonds might feel comforting, but you could find yourself disappointed after 10 or 15 years when inflation chips away at your purchasing power. So this is where you begin to fine-tune. Maybe you aim for a balanced mix that's strong enough to power through a 30-year horizon, but not so wild that it keeps you up at night. That's going to be different for each person. A business owner might say, I have some revenue streams in retirement, so I can hold more stocks. Meanwhile, another person might have no pension or extra income, so they want more GICs or bonds. The trick is to land on a spot where you feel comfortable staying invested, even during the storms. Because if you can hang in there, your plan has a better chance of success. Remember, you're playing a multi-decade game here. This isn't day trading, and it's not about nailing the exact top or bottom. It's about finding a strategy you can stick with, so even if the market slides, 1 year, you're not blowing everything up in a panic. That's how you ride the waves and still arrive where you want to be. So let's connect all these points together. A brilliant retirement plan is built on the assumption that things will not always go as planned. It includes ways to handle rough markets, inflation that's higher than usual, or a slowdown that rolls in at precisely the wrong time. And it uses layers of defense, stable investments, flexible withdrawals, and a mindset that doesn't rely on every year looking like a happy graph. If you're worried because you've seen your portfolio wobble, that might be a sign your plan isn't as sturdy as it could be. But the good news is that you can fix that. It could mean scheduling a chat with a financial pro who can run scenarios under different conditions, so you're not just hoping for smooth sailing. Or maybe it's about carving out a small bucket of safer assets that lets you relax when the market swings. Either way, the payoff is you get to keep building your life, your business, and your family's future without second-guessing every single dip. Because a single year of bad returns should not threaten decades of savings. And it won't if your plan has enough wiggle room. That's what it boils down to. Expecting less than perfect stretches and deciding in advance how you'll handle them. By doing that, you can face those curveballs without flinching. So let's pull it together. A resilient retirement plan doesn't assume every year will be smooth sailing. It expects a few rough patches. It builds in buffers like stable investment buckets, flexible withdrawal strategies, and a mix that balances growth with calm. Why? Because the real risk isn't a bad year. It's running out of money when you need it most. If you take just one thing from this, it's that the goal isn't a perfect plan. It's one you can live with through sunny days and storms. And honestly, getting this right could mean the difference between feeling panicked at every market headline or retiring with real confidence. Remember, the market may wobble, but a strong plan will keep you steady. And that's a wrap on building a retirement plan that can handle the rough patches, because the market will wobble, but your future doesn't have to. If you're wondering how this could apply to your own situation, maybe you're nearing retirement or just feeling like your current plan might be a bit too fragile, I'd love to help. There's a link in the description to book a discovery call, and we can talk through it together. Also, I'd love to hear from you. What's your biggest question about planning for market downturns? If you found this helpful, subscribe and hit the little bell so you won't miss the next one. We're just getting started. Thanks for hanging out with me today, and I'll see you in the next video.